Zach, it is good to see you, man. I am glad that you're back. Danny, it's good to be back.
Glad to have you back.
Now listen, lots going on here. I want to talk. Want to get to it all because I've got some things that I won't bury the lead. But do the fundamentals matter? Do the fundamentals matter in a downturn? I want to talk about that because that might incite some people. I've got a euro-dollar trade I want to talk about, but. Zach, I went back to the great state of Pennsylvania. I went home.
You've been out, yeah.
I went home, and it got me thinking. So I went to Mecca. Well, no, it's not Mecca. Mecca's a good thing, right? Like when people say I went to Mecca, Mecca's a good thing, right?
I think that's positive.
What's the anti-Mecca?
I don't know. Sheboygan?
No, Sheboygan's a great town. We are a pro Sheboygan podcast.
Michigan? Yeah.
No, we are a pro Sheboygan
Sheboygan's
podcast.
Great.
So anti-Mecca, whatever anti-Mecca is.
Yes.
So Graham on the flight home, right? Graham has narrower nasal passages, and
how old is Graham?
Graham is 6 months, and so the Graham man is 6 months. He's got narrow passages, and every time that he gets allergies, he has Tanya's allergies. The kid just oozes everywhere, right? And so poor little guy. The Graham man's awesome, and so we drive home after the airport, and like he was back there getting fussy towards the end of the drive because 2 hours from we fly into Baltimore and we drive up. And like this kid is just like a snot bubble, like the blob has encased Graham's face.
Oh gosh!
And so we noticed that night that Graham had what looked like snot. And by the way, this is going to end up. But if anyone's wondering where this story is going, I'm going to let me not just bury the lead too much here. It's going to end up at Morgan Stanley.
Okay.
Oh, all right.
Yeah.
Okay.
So just relax, guys. This is a good story.
Where else?
Yeah. Where else would it end up? And so we're like,
Did you do a drive-by?
No. So Graham's got like this snot that's what we think is snot pulled up in his ear because he's in a car seat, right? And it just like runs. We're like, oh my gosh, did the snot get that bad? That like, it's never happened before, but maybe it just pulled up in his ear. And then we noticed later after, we wipe Graham's nose up and do the little sucker to get all the snot out. There's more snot in Graham's ear. Now we're scared that Graham's eardrum has burst in flight. This kid was a great flyer. All the kids who have been great flyers as babies, great flyers. They're still great flyers. Yeah, like they're just great flyers. Must be the pilot, right?
Must be the pilot.
So we're like, oh my gosh, we got to take Graham to the doctor, but it's like Sunday. And we're like, who the hell is that? So they have some urgent cares up there, and there's a patient first. It's literally called patients first. Thank God it wasn't called patient last, right? Patients first. Mm-hmm. And we park the car. And no kidding, I look up I just like heads up, park the car. We're about to go in. I look up and there is anti-Mecca, the Morgan Stanley Berks County headquarters. I kid you not. And I'm like, do I take a picture of this? I'm like, no, it'll burn the retina of my camera lens. I'm not doing this. And I thought, I almost said to Tanya, hey, we need to go so I can get a selfie by Mecca with my middle finger up. And so then so anyway, the Graham issue is not. It turns out, like coincidentally, Graham had developed an ear infection. We just happened to go on a flight. Then, like you can put all those things together to think the kid,
miserable.
So then, and then anyway, it didn't clear up. It turns out he did have a little perforation in the ear. Anyway, Graham's fine. Morgan Stanley will never be fine. They reported earnings this morning, and boy, if you could make a toilet sound flushing, it sounds like Morgan Stanley right now. Like that was like a lawnmower.
It was kind of, we got that.
Yeah.
Anyway.
Well, we'll take it.
Nice.
And
That
so,
was a bomb. Yeah.
Sure. And so, like, how does that E-Trade purchase feel now, Morgan Stanley? Like, they bought E-Trade. They acquired E-Trade back in the pandemic because Robinhood was surging. If Robinhood is sub $10, what do you think E-Trade's valued at? Well, you get what do you get with E-Trade? You get the E-Trade baby. And I've got money coming out of the Wazoo commercials from circa 1999, 2000. And so.
Speaking of E-Trade, they originally came out, it was owned by Morgan Stanley and Dean Witter, like 60-40. And they were just directing all their trades to those two if they were a market maker.
Always a nefarious thing. But I want to touch on a couple things here. So I had a couple people reach out to me, and I want to apologize to them here momentarily, but not more importantly, just equally as importantly, you know what I realized when I went back home? I grew up in the greatest region in the country. It's the potato chip basket.
What? Potato chip basket?
Yeah.
They grow potatoes.
No, I don't
They
even
make
know.
potato chips.
Make potato chips.
Okay.
The Pennsylvania Dutch have figured out how to make the best potato. Zach, what's your favorite potato chip brand?
I'm like a Laser or Ruffles,
Oh my
right?
God.
I mean, you're gonna.
Yeah, that's like saying you only like Missionary.
Well,
and
no, it's like saying you only like Superman. Superman's great. All right, I love Superman. Lays are great. They're America's chip.
no. I'm going to tell you no. There's
Cape
better.
Cod.
Well,
All right,
that's
so
that. Well, that
like a
that,
kettle cooked.
That's
Yeah.
that now is owned by. I believe it's owned by a big one. Like they've been
It's
like
bought out, but it's
like
that's
they
the
make
flavor.
them look like Miss Vicky's is actually owned by Frito-Lay as well. So I live where I grew up in where the Pennsylvania Dutch are making kettle cooked potatoes. The potato chips I grew up with, right? Diefenbach's, great regional brand if you can get them. But I like Hers. Have you heard of Hers? Now Hers has some distribution.
Like his and hers?
No, HERRS. No, yeah, HERR. The apostrophe. It's Hers.
Whatever. Okay.
Yeah, the best Hers chip ever created is the Hers sour cream and onion chip.
Ooh, I love sour.
Yeah, I know. It's fantastic. And they do the right amount of sour cream powder and onion powder to the chip. There's a ratio that you have to get
bring
right.
any back, huh?
No, I gave up potato chips. This is my story. I haven't had potato chips in ever. And so we wanted to take Remy to the Hearst factory, but they stopped doing tours for the pandemic because Remy loves all things cheese curls, potato chips, and cheese ball thing. Like
Sure.
yeah,
after my own heart.
Yeah, and so we wanted to take
So
him.
you live vicariously through him. You watch him eat potato
Yeah.
chips.
That's
And,
right.
Yeah, and so, but here's the thing: like Lay's sour cream and onion chips are the worst sour cream and onion chips ever created. Like they are not good.
Well, hold on.
There is no love and attention to detail in the ratio of sour cream and onion flavors. As a matter of fact, I think it's just green paper. That the little specks of green paper they're spraying onto the chip. There is zero flavoring on a Lay's sour cream and onion chip. And I defy anybody to go buy a bag of Lay's sour cream and onion. And the worst Lay's sour cream and onion chips are found at your local convenience store because they've been sitting there for a while. And they say we sell we sell by weight, not air. You know, like we weight by not volume.
Right.
They are the worst chip. Oh, Don.
He's not having it.
Oh, he's not having it.
He won't sit for this.
I won't settle for this
Mute
one.
him till he comes
So
back.
the best chip in the world, and it, by the way, like Tim, you've named two brands, Hers and Diefenbach's. Utz now has national distribution because they went public as a company a couple years ago. Hers you can find a little bit of national distribution as well if people carry it. Kind of like Amoroso. I really thought he was going to come back with a bag of chips. He did come back with a bag of chips.
Oh my gosh, he does.
You got to go with John. What is that, Don? Move it over a little.
Lay's sour cream
Move it
onion.
over to your chest, Don.
There you go. Move it over to your chest. Over to your chest.
A little more.
There you go.
Oh, the worst.
Oh, there you go.
Yeah, I feel that's a sad lunch right there. That's a sad.
See, they've improved the ratio the last 2 years. You got to try them, Tim.
No, they have not. As a matter of fact, with inflation, I guarantee
God's
you.
going to eat them.
Yeah.
Folks, this was not rehearsed.
Yeah.
This is not like a staged.
With inflation, I guarantee you that it's gotten worse, not better. And so if you want, now you can get Diefenbach's, I believe, by mail order, but Hers by far are the best. And so anyway, I think that I have not appreciated because, we don't buy chips that often, but I know Remy likes them. And Nora, chip, and she's a two-fister, right? And so she always has to have two chips in her hand. This girl is fantastic. She loves the Hers sour cream and onion chips fantastically. And so anyway, if you're in, say, California, Washington State, Diefenbach's is spelled Dief in box. They're made in Pennsylvania. Hers are made in Pennsylvania if you've never heard of these two brands. Diefenbach's. I'm telling you, they're regular chips. By the way, there's also Goods chips, which are really good, which are really ironically good. Their sour cream and onion chips, the Good sour cream and onion chips, are not as good as Hers. And as a matter of fact, I believe that their barbecue flavored chips are a little too salty. Now, there's also the Adams brand of chips, right? And so Charlie's chips. And Charlie's chips used to come in a tin delivered to your doorstep, and they had delivery people. Like the milkman, there was the chip man. Not making that up. Oh, yeah, chips in a tin delivered by a chip man, not a milkman.
Now I think you're being facetious.
I'm not being facetious. You Google it. No, these are a real thing.
All right.
And so It's Charlie chips, and they have it's a tan tin with a black label, and anyway, I grew up in listen, as someone who is has been described in his past life as not fat but husky.
Sure.
I've eaten a lot of chips.
Yeah.
And I contend that the Pennsylvania area I grew up in, with all the chip varieties, better than French fries.
They get better potatoes up there.
Better than I'm telling you, man, the chip game in southeastern Pennsylvania rivals anyone's cuisine in any other part of the country. Now, speaking of people and where I grew up.
I can tell you why that is.
Go ahead.
Because they needed a good side to go with the awesome cheesesteaks in the area.
Yeah, there you go. Oh, by the way, cheesesteaks are
Don, you had to get them started now.
Very regional cheesesteak. We had some people up. So Graham was christened on Sunday, and we had some people up as godparents and whatnot. And they are not as familiar with cheesesteaks as I am. Now, again, being what would be known. Now, my dad used to refer to me as, you remember Garfield the cat?
Yes.
Yeah. So there was an episode, like when I was in like 85, 84, I was a youngster, really young. And he heard on a Halloween special or whatever we were watching on a, special used to come on CBS for Garfield. He heard John Arbuckle, the Garfield's dad, right? He heard John Arbuckle refer to Garfield as a lard ball. And so he referred to me then from that point forward as a lard ball. Not
lard ball.
Lard ball. Yeah. Ouch. Well, listen, our house was a tough household. And I'd come home and my mom would look at me and she'd go, You put on weight? Like my mom was she's awesome. I love my mother. It's just a tough household, right?
Yeah.
Yeah. And so anyway. That story is loving. It probably doesn't come off as loving. Your dad called you a lard ball
with chips like that. How
could you not be, right?
Yeah,
and so anyway, I know my cheesesteak game too. So cheesesteak's very regional, and so where I grew up, cheesesteaks are American cheese mixed obviously with the meat, grilled onions in there, and then it's always sauce on top, like a marinara sauce. Always a marinara sauce on top. There's no other way. But then when you go down towards, you get really close to the corner of Pennsylvania, they get the whiz going. I'm not a fan of the whiz.
Yeah.
I'm not a fan.
Cheese whiz, yeah.
I'm not a fan of it. And they'll refer to with the sauce on top as a pizza steak. I'm like, no, that's the way they come. And so there's a regionality to cheesesteaks as well. But I think the chip game though will change people's lives. So if you find yourself in Sheboygan, Phoenix, Arizona, maybe Costa Mesa, California. What you want to do is find Charlie's Chips. You want to find Goods. You want to find Diefenbach's. You want to find hers. And then you want to get yourself going on the chip game. And it'll change your life because you won't buy chips from your local chip.
And then people will call you lard ball.
Yes, the path. Listen, the path to prosperity. If back in the days of oligarchs and kings, if you were portly, that meant you had money and wealth. Get fat.
Yep. That's why gout is the king's disease.
Yep. And there's a phrase. There's a phrase you never thought. Can we just call the show "Gout is the King's Disease" and be done with it?
Yeah, maybe.
So as I switch here, but real quick, there's a power to what we're doing here. So stock nerds and market lovers, there's a group of you out there that are like, just tell me about the euro dollar trade, and I'll do that because the euro is at parity, and I've got a trade for you. Okay, but there is
for research.
Oh yeah, let me do this right now. Stock nerds and market lovers, you know what this show is for: potato chip recommendations, cheesesteak, how to get them. Self-deprecating fat humor. It's also for edification purposes only. If you are listening to the show and you think any of this is advice, well, my friend, you are surely mistaken. You, my friend, are being entertained and educated. E-need, as I like to think of it, and you are having a good time. We get you into the tent, and we educate, and then we send you back out the door after the show is over, and hopefully to interact with us, to grow with us, to maybe for edification purposes only, discover some of the things we're talking about.
No buy recommendations for stocks, only potato chips. There's buy recommendations for chips, but not stocks.
Yeah, we call those BPs, buy potato chips, BPCs. Anyway.
Those Lay's sour cream are at best a hold, by the way. Not
buy, sell, or hold, man. They're a hold. They're the chip you buy when you're desperate for chips. Like they're not like This is the chip I'm going to take to meet my mama. These are the chips that you just, okay, we'll do this again. And then you're sad afterwards because you did Lay's.
They're like the Little Caesars pizza chips. Acceptable. Wow, they're not preferred. They're cheaper.
They're pretty skinny.
They get you over the line.
Some people love them. My mother-in-law loves them. I don't.
And it doesn't matter where you met Lay's. You met Lay's at the bar. You met Lay's at the convenience store. You met Lay's on an online chip site. It doesn't matter. You just don't want to bring them home to meet your parents because they're not.
Lay's has at least 50 flavors. There are all kind of qualities,
but it doesn't matter where they spray the flavor. It's the base chip
the potatoes. The problem.
Like they can spray they'd be better off spraying the flavor on cardboard.
The call is coming from inside the potato. That's where the problem is.
That's where the problem is. Yeah. So I also listen. I wanted so back in Pennsylvania, I got a couple messages. The power of the stock nerd and market lover community is something that is never ever taken. It's not lost on me ever, and it's not taken for granted here one bit. I had a number of people reach out to me and say, "Hey, do you want to meet?" I didn't know we had this many people. I really didn't. In Berks County, where I grew up in and around that area, that listened to the show. I genuinely didn't know, and like there was Paul and a couple other people that asked if we could get together, and Paul even knew about this great ice cream stop for the kids called the Cone, and it's a giant. Like they brought it in from some roadside stand in this small little town that's close to where I grew up, and it's a giant ice cream cone, like roadside. It's awesome, right? Now, granted, I didn't eat the ice cream there because I gave up sugar. The kids love it, and Nora loved it so much she lost the ability to speak again, and she just starts roaring at you. Like she'll just go, "Hi, Dad!" Rah! Like the sugar is coursing through this girl's veins. It's homemade ice cream. So anyway, the Cone is awesome, and so I couldn't meet. I couldn't meet with anybody. We had a pretty tight schedule, and I apologize, but I'll be back up soon enough. And if you are in the Berks County area, I would love to get together because nothing better than getting together for coffee, trashing a little Morgan Stanley, and meeting stockholders and market lovers. Or a lot, yeah. And so, look, Eurodollar. So euro is at parity. And how can you take advantage, other than flying to Europe, right, and getting a great deal on a European vacation, just like they could fly here now, anyway. As they export goods over here at a better rate because the dollar is so incredibly strong. So if your platform allows you to trade euro dollars, which Thinkorswim does, and so the risk reward here is astounding. Now, normally euro dollars, normally the pound, the euro dollars are priced higher than USD. And so what happens is it isn't just limited to this specific currency, folks, but we're going to use this one for example. So what happens when our Fed tightens and the dollar gets stronger, the euro dollar goes down. Mm-hmm. So you can make a very low risk bet. Like you could bet, and it's a bet, right? That this time next year, 2023, like go out to September 2023, that the Fed will have screwed this up so badly that you're not going to be talking about tightening anymore. It's going to be the Fed easing. And at
that point, you'd want to unwind the trade because it would switch.
Well, the euro, yeah. And so when the Fed starts to ease, the euro dollar starts to gain strength. And
against
so
the dollar.
Yeah. So what you just trade euro dollar options. Don't even pair it against the dollar. So you would buy, say, the 97 euro dollar calls, right, for September 2023 or October or whatever month you choose to go year out. And then you would sell the 98 calls against it, right? And you're like, Tim, it's only $1. What can you get for $1? Well, a lot. Like it's about $400 or $500 worth of risk against $24,000, $25,000 potentially for reward. It's an amazingly powerful trade setup. And so, but for the trade to work, the Fed has to let off the gas pedal with rate hikes. There's no rush on this trade, right? Mm-hmm. But you're going to find a lot of currency imbalances like this, and these haven't happened. Like you've probably heard that the euro hasn't been in parity since I think 20 years ago, like coming out of the 99-01. Yeah.
Well, an economic crisis too.
Yeah, and so The euro hasn't done this. The reason why I'm bringing this up, this doesn't happen often. And so these are unique situations that if you're aware of them for edification purposes only, you can research. And even if you're like, I'm not even interested in this, researching how currencies react to the dollar is incredibly powerful, because you'll then start to because then you'll take how currencies react to stocks, how currencies react to metals, how metal, or vice versa, right? And I think it gives you, more wherewithal. And it's another tool in the toolbox to give you an overall picture of just how bad the market has become, because this doesn't happen unless you've got something going on. Nefarious is the wrong word, but I can't think of another word though.
Well, basically, we're tightening and other central banks aren't.
No, they're tightening in Europe.
But not like we are.
No.
It's all relative basis.
And that's an important point. So let me expand upon that. So what we're doing now is the most aggressive fiscal tightening in our country's history, meaning that we're just erasing. We're hitting delete on the spreadsheet with all the bonds.
Right after the loosest monetary policy in history just a year ago.
So now, not only are we raising rates, we are we're tightening the money supply. Mm-hmm. And so that's the technical term. And so we're tightening the M2 supply, and that's a double whammy. Normally in the history of our country, we just raise rates. That's the tool the Fed has used, but they increased the balance sheet to record levels to the point where they were buying corporate bonds. The Fed was buying, not just normal bonds, like business bonds, like company bonds. And so, yikes. And so now all that is being unwound or deleted from the spreadsheet, meaning they're not going to re-up the purchases. They just go away. And you've got this rate raising. And so what really I think the market is looking at here is what Canada did yesterday. Nobody talks about Canada fiscal policy, right?
No.
You do on your videos.
Yes, I do. Because Canada raised their, they did 100 basis point raise yesterday morning. And
1%.
Yeah, 1%. That's a big deal. So there's a Fed speaker today, Bostic, a little later today. We're taping the show early, by the way, folks. Thursday, the 14th, Vice on the 15th. So Bostic speaks later today. And we're going to find out a lot today about what the Fed is going to do, because the Fed, this Jay Powell Fed, has sent out its messengers to lay the groundwork for what's going to happen. And so if you hear Bostic, and there's another speaker on Friday as well, if you hear them talking about the acceptance of the possibility of a 1% or 100 basis point raise in the July Fed meeting, then I think that's a signal that they're going to do that.
Market's already signaling that.
Well, it's a 25% possibility right now.
No, I get it, but I'm saying the market is the best leading indicator around, and it's signaling that whether it's 1% or not, it's signaling
Bostic
continuing tightening. And
so you'll see the market probably rally here if Bostic comes out and says, no, we're going to stick to, we think 75s.
It's more dovish.
And by the way, that's interesting. It's an interesting, what you just said, word dovish is interesting. If Bostic comes out and starts saying, hey, 75s or consistent 75s are what we think are needed, then the market, the market probably rallies on that, because it's not 1% or consecutive 1% raises. The 1% raises are, we can debate to the cows come home if that's what the market needs or not. So you can make the point, that that's what it needs. I contend, see, now this all ties together. I've been contending, it just feels like forever, but you only get CPI and PPI reports, Consumer Price Index, Producer Price Index reports, but once a month. And I picked up on in June that crude, RBOB, gas futures and soy, corn, wheat, hogs, lumber were all coming down. Mm-hmm. Their charts were breaking. Mm-hmm. Oil's down to 200-day. But that was like four weeks ago. I was like, if it comes down to this zone, it's probably, if it breaks this zone, it's probably come down to 200. It's already there. And so natural gas broke, but it bounced off the 200-day. The next CPI report you're going to get is going to be less energy. Like the prices are just down. Like they peaked, and now unless they re-peak again, the report for July. So you got June's CPI. If the trend holds, we're halfway through the month right now. If the trend holds even, or if these commodities do go lower, the August CPI and PPI report are most likely going to be lower. And so then, if you can put commodities and energy not on the back burner, but just like on the side burner, the ones that's simmering, now this is all about what the Fed's going to do. And does the Fed tighten to the point where they stamp out, like they kill inflation to the point where they've burned the house down and now we're going to rebuild? Or is it just like we contained the fire to just one room and there's a little smoke damage, but we can rebuild and it's going to be fine?
They call that a soft landing.
Right. And so that, I think right now, and I'm not saying, look, $4, like it's $4.70. When I got up to Pennsylvania, it was $4.70, $4.75 for a gallon of gas, right? Where I traverse. And when I left Pennsylvania, it was down in the 430s, and that got me interested. I'm like, I wonder what it's down in Texas, and or down by where I live in Texas here, and it was sub 4, and so there's always about a 50, 60 cent difference between where I live in Pennsylvania and where I live in the Dallas Metroplex, and so that percentage wise, these are big moves. And so, what would be causing that move? Oil's coming down. Did Jay Powell win? No. Well, it's a guess on my part, right? This is
PPI came in hot this morning, and so that's going to be coming out in CPI next because it goes through the producers' price index first.
If they raise rates, I mean, if the producers raise prices.
We will. Okay.
Yeah, if the producers, listen, this is what you just hit on is the heart of the issue. There's producers that can raise their prices and get away with it, and there's companies that can't. And so, what are they doing?
They keep the price the same. They lower the volume you're buying, so you got to buy more, but you don't know it.
That's cynical. No,
you're damn right.
No, I don't think it's 100% accurate.
Okay.
That changes over time. What they're doing now is what Walmart's doing and what Amazon did a couple months ago. They're charging all their sellers, even the big ones, fees for fuel, fees for storage. And in the most grotesque, that's industrial. Like that's.
And you don't think that's going to be passed on to the consumer?
I don't think there's enough companies that have pricing power to do that.
That's absolutely,
that's where I'm saying.
So it won't be dollar for dollar increase, but a percentage of that will be. All I'm saying is I think CPI is still going to go up a little bit next month. I do believe it's the rate of growth, the rate of increase is slowing, and I think it is peaking at some point. I just don't think we're quite there yet, but we'll see.
No,
you make a very valid point.
But
oil was down 6% for June. So saying that oil, which they blamed quite a bit of it on, is not accurate, and that's why the core actually. The core does not include oil. It was higher and it was blamed on energy, but oil was down 6%.
I think what the Fed is doing now is killing demand. And so if the CPI and PPI reports are to be, and who knows, are to be lower, and that's one of the things that not only the Fed, but everybody in America is looking at now. Now it becomes an issue of killing demand and getting prices cool, not passing them on. And so if you can get home prices to just level off or cool,
which is happening.
If you can get everyday items to pause, it's not going to happen overnight. That is the start. But right now, like everyone's going to get hurt, whether it's a
baby boomers already took a 6% pay cut this year.
Yeah, and the increase, the biggest Social Security increase isn't even near enough to cover the rate of inflation.
This year's increase. Underestimate because it's a lagging the COLAs, and I was going to talk about that.
Go ahead.
Well, okay, so these are for the retirees, Social Security, COLAs, and your money. Okay, the COLA increase projected for next year is 10.5%. That's the second highest. In 1981, it was 11.2. But that's a 1.9% higher than what they anticipated just last month. That's 22% higher than what their estimates were for last month. So all these economists and all these forecasts, they've been wrong in perpetuity going back. So I don't know why anybody still listens to them going forward. But the main thing is for this year's COLA increase, which was big, it was around 5-6%. Inflation's running at 8 and 9, so they're behind. They're actually behind this year by 5.9%, 6%. So if they're on a fixed income, they have 6% less money to spend. Now I was talking about PPI. It came out 1.1 increase this month over month. That's 11.3 annualized. So right now, CPI is around 9. PPI is 11.3. So yeah, it may not go up higher. It may be flat if they can't pass it on. But the whole point is that these adjustments these people are getting are not, they don't happen early enough. And so that alone hurts demand. And here's the other thing, Tim, think about this. Those increases aren't indexed for inflation. So it could push a whole bunch of people getting Social Security benefits into that taxable bracket. In other words, their Social Security benefits may become taxable. So your net Social Security benefit may not be good. Anyway, I just wanted to bring that
tax dollars paying for tax dollars.
Yep.
So, and I've got an email in here that I'm looking at right now from a great stock nerd, market lover, and he's talking about like Ray, pontificators like Ray Dalio and who did he mention? Harry Dent. I think in this market environment, and I was talking with someone else on Monday about this. This email references the commodities that I talked about on the video and last night's video, and we just mentioned now. And he's saying we're going, our country's getting ready for a great reset.
Mm-hmm.
I don't. It's already happened in tech.
Mm-hmm.
Like there's already been a great reset,
mm-hmm.
and so until. When do the fundamentals matter?
Well, they're talking about real estate. They're talking about a big flush and a bunch of other sectors.
And we could talk to the cows come home. It doesn't matter what I think. It doesn't. I think what we've proven in this country, though, that there's a form of MMT, modern monetary theory, that will be employed because it was employed for the first time in 2008, where we bailed out the corporations, learn from the mistakes, give the people the money, they'll spend it, and that's how the economy was.
Whoa. They didn't give the people the money. They said they were. They gave it to the corporations and built up their balance sheets. Didn't help the consumer that much, and that's why you didn't
in 2020?
In 2008.
I said that.
Oh, I'm sorry.
Sorry.
And this time they gave it. But hang on. This time they gave it directly to the people, and that's why you got this inflation.
But you can't argue that. Well, you can. You're going to argue anything because I know you. They gave direct stimulus payments to the people. And that helped a bunch of people.
They did when they shut down the economy.
Yeah,
right.
that's
once they started opening up the economy, they needed to pull it back, and they didn't.
You're not going to hear any argument from there. But those payments did save the economy, and so they'll take this whole thing to the tipping point where folks like Harry Dent and who's the guy Schiffer Sweeper,
Peter Schiff.
Thank you.
Harry Dent's a one-hit wonder.
They become super relevant again, but they'll take this to the point where they get everyone thinks the economy's on the brink, and then it'll be the March of 2009 moment. It'll be the March of 2020 moment, the end of March, beginning of April. It'll be the March, the first week of March 2009 moment, where you start a rally with a 5/8 cross on a weekly chart, and it doesn't look back. And no one will believe it because they've got the economy on the brink. And so I'm looking at this email right now from this super nice fella, and I've had a discussion with a great stock nerd out in California, and do the fundamentals matter? And not in a downturn, but they don't tell you. And if you want proof of that, my screens that I do when I ran these on the video for you Wednesday night, something like I think the title is something you won't. This never happens. A screen you have to see to believe. My loosest of stock screens gave me any stocks, but my high quality growth screens that combine 70, there was no stocks there, and I can't remember when that happened. And I only built those screens after I left IBD. I knew I could replicate what was going on, but I wanted to see if I could match them. And the screen that matches greatly, really well, is the one that's with 300,000 advancing volume. The one I showed, I believe, first or second. There's no stocks there, and so if you're at home and you're arguing with the market because, like NVIDIA is a great company. The things that NVIDIA powers are desperately needed in a lot of things. But NVIDIA is just bouncing along the lows, right? And there's companies that make wonderful things and great technologies that are going to fuel America's prosperity moving forward. But they're just not loved by the market right now. And so if you're at home arguing about the fundamentals, understanding your situational awareness to where you are in time and space is incredibly helpful here. And this puts a bow on it, the whole segment. That you need a trigger now that gets you over the hurdle eventually. We're not there yet, I don't think. That gets you over the hurdle that helps you raise the I believe hand. Because they're going to drive this economy to what looks like something that could be worse than 2020, something that, early.
Yeah, the precipice.
Yeah, something that could be worse than 2008. You've already had it 2001, or 2000, excuse me, 99, 2000. And the market's going to give you a signal that it's ready to rally, and you need to be there to take it.
And it's going to feel wrong.
It's going to feel wrong.
Yeah.
And so that 5-8 cross, I did it on the video. It was 10 on a weekly chart.
Now that's assuming you've also moved heavy to cash earlier.
Oh,
you should have already done. You should have already done it.
Well,
the market told you, and you're talking. The fundamentals matter on Main Street, but you have to have technicals for Wall Street because they don't move in tandem.
Hold on, that's a really good point. You make a really good point. If you are in a situation, your parents, your loved ones are in 100% invested, raise no cash because you're at Edward Morgan Stanley Jones next to the vape shop.
Pie chart, I'm sorry.
You wouldn't it be ironic if there was an Edward Jones next to a pie shop? That'd be funny. There's a bakery next door to one of these places. Anyway, you have to have the cash to do this. And it doesn't feel right because they scare you with FOMO that because you get these big rally days. And look, your signal, it doesn't have to be your signal, but my signal is a weekly 5-8 cross. And when that signaling works, you know when you're wrong pretty easily. Do it on daily chart, doesn't matter to me. But you're not going to believe it. And the people around you, if you should talk to them, aren't going to believe it. And they'll tell you everything that's about to fall apart in the economy and everything else. And so right now, we're not there yet. The Fed hasn't revealed all of its cards and how hard they're going to press. You're going to get a clue today from a Fed speaker this afternoon. You're going to get maybe late this morning. You're going to get a clue tomorrow with another Fed speaker in the afternoon about what they're going to do for July. And then we'll see how the market reacts to that. But do the fundamentals matter right now? Heaven forbid I say no. But you're in a bear market. And right now, it's just taking everything out to sea.
Cash is king.
Yeah, and having that ability to deploy it at the right moment, at the right time, and understanding when that moment is in time. And you haven't had that, by the way, in a weekly chart in a very long time. So hopefully that helps, stock nerds. Love you. But let's do this. Let's get to Hunter. Hunter's got a bunch of stocks to research, and then we'll get to Don.
All righty, guys. So actually today, pretty simple, straightforward, stupid type of analysis for me today. And really it corresponds to the dollar. I know we've been talking about the dollar on this show for a while, and it corresponds to the stocks that have shown relative strength over the course of the last, call it 2 months, 3 months or so. So we're going to run through a quick list of names here, as well as a couple of sectors that I've talked about. And my point is going to be simply to keep an eye on how these perform relative to the indices, move, especially if we're in a position where we ultimately see new lows on the indices and so forth. So, Don, I think you got the charts today. So first name, a name we've talked about nightly videos as well, Celsius, CELH, one that has shown pretty immense strength over the course of the last 2 to 3 months, as you can see, kind of going back to that low in May, has continued to kind of move up and stair step higher. The market is down today, so most of these are going to be. It's not so much a day to day thing that you want to look at here. What you want to focus on is what is the actual stock doing versus the indices. Here, only 2 or 3% off the lows on the S&P. Celsius obviously much higher off the lows than the indices itself. So just moving forward, I'm going to provide about 4 names here. These are some of the best looking names in my opinion. And in my opinion, all you got to do until you start to see that turn, like Tim was markets, because right now this is poor price action. We're bouncing off the lows a little bit today. But you look at that chart of the S&P, and that doesn't really inspire confidence. Now, could things turn around today? Sure, they could. But my point is simply monitor how the stocks that have performed the best versus the indices over the last couple of months, moving forward, monitor how they perform in the future. Same thing, we want to see an RS line that's angling up. If we see the S&P drop 15% in the next month, we want to see individual stocks that only go down 8%. That's what we're looking for in these names, is the ability to hold up better than the indices. And that's what we've seen start to develop over the course of a month. So Celsius is the first name there. GTLB, the next name, one of the top looking names in my opinion. And same situation here. You want to see this one hold up better than the indices. And as you can see by the angle of that RS line, it has been doing that basically since about the same time that we just pinned on Celsius. Since middle of May is really when we started to see some relative strength start to show up in some of these growth names that have just been beaten to oblivion. And when I say beaten to oblivion, a lot of these names that have had 60, 70, 80% declines, and GTLB is no exclusion here. But you want to see healthy action. You want to see stair stepping up the right side of a base potentially, which is kind of what we're starting to see here with GTLB. You want to see the pullbacks contained. You want to see buyers willing to step in, and you want to see relative strength continue to climb upwards. So GTLB is the second name. Bros, a coffee company, a name we've talked about a pretty good bit over the course of the last year on this show. Another name showing some relative strength today. As you can see, this name's up 2% while the S&P is down 1.5%. This is exactly what I'm talking about. This is what you're going to want to be looking for, is where do those names that are hanging in there better than the indices, that are showing healthy price action while the indices are not. And simply put, those are the kind of things that lead you to say, okay, this might be a leader when the market does turn. Doesn't mean it's going to be, but this is how we compile a list of the names that act the best, that have price action, have the best patterns, etc. When the market does start to turn, we've got names that we think have potential leadership qualities. So Bros is the name here. SWE, which has been weaker recently, but it's a biotech name, a medical name. Shockwave Medical, another name that has shown nice relative strength, evidenced by that RS all over. And pretty much that point in middle to kind of early-ish May is where you see a lot of these growth stocks RS lines start to really angle up. It doesn't continue at the indices part. It's been a really big clue, and they've continued to act better than the indices for the better part of the last couple of months. And then last XBI tech sector, I know, and myself have this one as well. Basically the same exact concept.
Hunter, you cut out. What was the ticker on that?
XBI, biotech.
Okay.
Yeah. So same concept, same thing. See here, right around the middle of May into June, you see this RS line start to angle up pretty nicely on XBI. You're looking for the same thing. Does this index or this hold up better than the indices? Obviously, it's much higher off the lows than the S&P, than the Qs. It's had some really nice volume come into it over the last couple of months as well. So same situation here, just on a sector basis. And then TAN, the solar ETF, This one can be pretty jumpy, but doesn't look long, I would say, as XBI, but you do see that RS line moving up sharply since about the beginning of middle May. So a couple of sectors, a handful of names. Keep an eye on those names, and there's plenty more that you can go through and find that have similar looking RS lines or similar patterns. But that's what we're watching moving forward, is how do these names that have shown really nice relative strength, really nice price action over the last few months, how do they hold up moving forward versus the indices? And then last thing here, Don, and talked about a lot, is UUP, the dollar. Now, this is extended today, obviously, as you can see by the chart there. But what's important here, Don, if you can pull this on a weekly, this is a clean breakout over the highs from 2020 on the dollar. And that is reflective of the fact that the Fed is basically saying, hey, we're not going to budge and we're going to get inflation under control. Obviously, that hasn't happened yet, but we've seen the odds of 100 basis point rate hike drastically increase over the course of the last few days since that CPI report. It basically went from 0% to over 80% in a matter of 2 or 3 days. This, as long as this continues to move, look at the RS line on UUP. I mean, it's essentially vertical. And as long as this continues to move significantly higher, it's going to present short-term difficulty for U.S. equities, specifically the growth stocks and things of that nature. But I mean, like I said, it's extended, it's pulling back today. Maybe it takes a breather. And we've seen over the course of the last couple of weeks, when UUP has taken a breather, it's given rise to equities having some pressure lifted off of them. So UUP, I would say, is one of the most important things you can pay attention to, along with rates. But as this dollar continues to show just immense relative strength, it's going to be tough on these, at least in the near term. So just keep an eye on the dollar, keep an eye on the rates, compile your list of stocks that have shown relative strength over the last couple of weeks and monitor them moving forward. So that's my advice. That's my simple analysis today. And I hope it's valuable to the listeners. But that's all I got, man.
Hunter, can you really quickly pull up Roblox? I had a stock nerd write in and was wondering about Roblox, potential double bottom in Roblox, and address overhead supply with Roblox.
Yeah. So first thing I want to point out on Roblox, the first thing that stands to me is you're starting to see some accumulation volume pattern. And what does that mean? That means big, tall blue bars, if you're looking in MarketSmith, that are higher than the red bars. So you see like 3 of those in the last month or so, as well as some big volume after their last CPS. And to me, that's the first thing that stands out. Secondly, this is just like a lot of other growth stocks. I mean, this went from $141 to $21 in 7 months, 8 months. So a massive decline, but you've now seen the moving averages come all the way down and catch up to it. You've seen that get back above some of those moving averages. And you're starting to see what looks like the beginnings of some actual base building and potentially coming up the right side of the base. Now, to your point on supply, Roblox, as well as 99% of the other growth stocks out there, it's going to be an issue for them, at least in the short term. Now, say, 6 months to a year goes by, that becomes less of a problem, especially with the amount of trading that goes on now and just the amount of liquidity in the market in general. For the time being, you might have people that were buying Roblox at 50 and 60 and 70 that are just waiting for the chance to sell. So it's something you always want to be mindful of. These stocks that have had huge declines, it's going to be something that's going to be kind of heavy on the stock, at least for the near term. The longer we go out, that becomes an issue, and the more likely it is that a lot of those people that were trapped or bought at a lot higher level have ultimately exited their position. But certainly, I mean, one of the darlings of 2020 and one of the last names to really break out in the growth space. It broke out right before the market kind of started to tank a bit, showing some signs of life, showing some attractive volume patterns, some good price action, some nice relative strength, but just kind of in the early phases of possibly working up the right pace. So yeah, I hope I covered that pretty good, Tim.
Awesome.
And those moving averages are starting to hook up.
Yep. Okay. That was awesome. All right, Don, you're up, man.
Yeah, I want to show a tool that we use frequently in-house to as a double check on relative strength and performance of some of the things that we have on our various watch lists or that we're holding. And I'm going to start with the S&P 500 and put it on a MarketSmith comparison chart. And then I want to bring up, I'm going to change this to the last 3 months so you can see the performance of the S&P. And then we're going to benchmark. Let's talk about the 2 sectors that Hunter identified as things to keep your eye on. First, you've got an overall performance over this 3-month period, 3 month plus. So we're really talking about the second quarter and then July. S&P down 17.6%, biotech down 9.8%. You can see underperformance, and then we talked in June about how the relative strength really started to pick up. So compare what the S&P is doing to what XBI has done since the middle of June. And this is how we identify outperformance within sectors. We also mentioned TAN. TAN kind of going sideways with the S&P. The big move for TAN was back here in May and June. So let me clear this out. And then you can also do a comparison chart on the entire 21 over 21 list. So I'm going to bring. This will take a second to populate. So this is the entire 21 over 21 list. Let's look at it for just the last 3 months and bring in the S&P 500 as a comparison. So you can see the widely varying returns. S&P 500 down 17.59%. Some of the things on the list negative, some extreme standouts like PDD up 30%, Celsius, which Hunter mentioned, up 31%. But you can see while the S&P has trended down during this period, for the most part, these stocks are trending from the beginning of May higher. It gives you a good opportunity. Normally, I put these on one by one. I don't bring everything up, but I just wanted to demonstrate one of the tools that we use in-house. And the returns of all of these various stocks from the beginning of April relative to what the S&P is doing. This is another check that we use to keep our finger on the pulse of relative strength, both on a stock perspective and a sector perspective. The S&P 500, getting back to it, I want to bring up a 60-minute chart here and show how important the level that we're currently at is. This was the most recent, the prior CPI report. Late in the day on the 9th, we broke down. The next morning, CPI was a bad report. We gapped down, didn't recover. Compare that to this CPI report. Here was the breakdown at the end of 7/12. We gapped down in the morning but finished high. It wasn't until the second day that we've had this follow-up gap down after CPI. And look how key this 3,700 to 3,730-ish area is here. Today's lows, if we pull, today's low is currently 3,721. We pull back to 3,700. This is a huge area. You just have this 2-day island from back in June 16th and 17th that we recovered from. So briefly dipped below 3,700 in mid-June, quickly recovered it. I haven't looked back to that since, but we're coming up to the bottom of this range. If we break this 3,700 area, this next level down, 3637, becomes extremely critical, because if you go back on a daily chart, you've got no support at all under this level. So those are the key areas that we're watching on the S&P to give us a gauge for what future action might happen. People that have been following our videos know we took some longs when we got back above the 21-day exponential moving average on 7.7, 7.8. Then we failed. It rolled over. We got out of our longs, went short when strength came in intraday yesterday, and it looked like the low of 37.50 was holding. We got out of our short for a small gain. Wishing now, obviously, I would have held it, but that's hindsight. You just go with what your rules are and don't look back. But now this next level down, 3,700, extremely important, or we're going to see this was being the first leg down, a bounce, this being the second leg down, a bounce, looking at a possibility of the third leg down. Or you could say that this was the bounce from the second leg and we're in the middle of the third leg already. But typically the third leg goes steeper than the first two legs. That's certainly not good news for bulls, and it's certainly one of the big reasons why we preach once you're under this huge 200-day moving average, risk picks up. And this is just history and math telling us that it's just a fact. Don't let people say, well, after a recession comes on, if you look out 3 years, the stocks are always higher. We could easily go 20% lower from here. We did in 2000. We did in 2007, 2008. We're in unprecedented inflationary times versus the 70s. And there's no confidence whatsoever in consumers or in people that are holding positions at this point. The buy and holders are never going to let go. That's just what they do. That's one of the fallacies that Wall Street likes to give everybody, is that you can't time the market. We don't have to time it. We're just going to follow the trend. Right now, the trend across all three of the time frames that we track, short-term, medium-term, and long-term, are all down because we're below the long-term 200-day. We're below the medium-term 50-day. We're below the short-term 21-day. That just tells us not to be a hero. Get out of the way. There have been some stocks that have been showing some resilience, but sometimes with those you wake up and boom, all of a sudden you're down 6-7%. Cigna was one that was holding up very well in the hospital managed care, in the managed care group. If you woke up to Cigna, they were downgraded this morning. They're down 4% today. It was holding up great, above the 21, had a breakout. Breakouts failed. Breakouts don't work in bear markets, no matter what sector the stock is in. This is absolutely a market where any strength has to be sold. If you're going to buy, you better be buying at the bottom of the range and not the top of the range. That's the only chance for you to chip away and make a little bit of money in a market like this. We don't really look to scalp. Sometimes it appears that we're doing that, but it's really just a matter of us following our rules as far as getting in, getting out, and sticking to the rules that we've got in place for the type of market that we're in. Take a look at watch for the 21/21 list on Friday. It had held up pretty well, but over the last couple of days, at least 8 of them have broken their 21-day moving average, and that is they may recover by Friday, they may not, but that's another gauge that obviously we like to keep track of for how our stocks are performing.
And by the way, I want to just point out, he was talking about we unwound the short for a small gain yesterday. We were actually net short, so right now we've got almost all cash, just 1 or 2 positions, and the market's down as of this recording right now at about 10:27. The market's down about 1.35 on the S&P. And we're kind of flat. So that's why cash is important. Cash is king on the way down, and cash is trash on the way up. So you dial up and down risk with cash, and that's exactly what we've been doing. You got to get out of the way when it's ugly.
All right, Danny.
Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com, and up on the top right, there's a subscribe button, and we won't spam them. It's up to them to reach out to us if they want a complimentary portfolio review, have questions about any stocks, or have a topic they want to heard on this podcast or on the Daily Market Insight videos. That button, if you subscribe, will send our Daily Market Insights every day and this podcast right to your inbox. You can always call us old school at 855-REAL-WEALTH. We'll talk to you next week on Your Money.
Barring any exogenous events.